If it don't make dollars, then it don't make sense. I gotta get paid. I'm steady trying to make $1 out of 15 cents. I gotta get paid. If you ain't talking money, then you ain't saying shit. I gotta get paid. Nothing move but the money, yo, it ain't no game. I gotta get paid.
What up? Welcome to the 12th episode of CryptoCast, presented by Cream Scheme. On today's CryptoCast, we'll examine how you can beat the terrible interest rates that banks are offering on savings accounts by making use of stablecoins. If you are unfamiliar with stablecoins, stablecoins are cryptocurrencies that have their values pegged to an outside asset, typically a fiat currency such as the US dollar, which is the specific example that we're interested in for the purposes of this CryptoCast. This value peg allows stablecoins to not fluctuate in price as unpredictably and as wildly as other cryptocurrencies. The most common scenario for how a stablecoin is issued is an entity storing the asset backing the stablecoin in a reserve and then minting units of the stablecoin against those reserves. For example, Entity A wants to create Entity A dollars pegged on a 1-to-1 basis to the US dollar. They hold $5 million USD in reserve and mint 5 million units of Entity A dollars. Theoretically, under normal conditions, the expected price of an Entity A dollar would be approximately, if not exactly, $1. Investors use stablecoins for several reasons. Historically, the most popular use has been exchanging volatile cryptocurrencies for stablecoins, preserving the dollar value of a given position without necessitating that the investor leave the crypto ecosystem. In recent years, numerous platforms have emerged that offer interest-bearing crypto accounts. If you are familiar with how bank accounts work behind the scenes, you know that the money that you hold in your bank account is basically money that you're lending to the bank. They take those funds and loan them out, which allows them to pay you interest. That interest comes from the profit that they generate from these loans. The platforms offering interest-bearing crypto accounts follow a similar model, except that they invert the model that the banks use. Where banks might keep 80% or more of their profits and pay only 20% or less of that to depositors in interest, the interest-bearing crypto account platforms are paying out about 80% of their profits to depositors. This is the key that allows these platforms to pay rates that are multitudes higher than what banks are paying, even with the so-called high-yield savings accounts. For example, a 10+% APY for stablecoins versus a paltry 0.6% APY at best for one of the highest yielding online savings accounts. Before jumping into a few crypto platforms for you to consider, it is important to note that one major benefit of traditional banking is FDIC insurance. Interest-bearing crypto accounts are not FDIC insured, although many platforms do procure asset insurance to protect against hacks, asset theft, etc. Although it seems like more and more platforms are popping up every day, offering interest-bearing crypto accounts, 3 platforms that we like here at Cream Scheme are BlockFi, Voyager, and Celsius. You can check the description for links to each platform, as well as our referral codes for each, if you choose to create an account. If you use our respective referral code for each platform and fulfill the platform's requirements, you can get $10 in Bitcoin at BlockFi, $25 in Bitcoin at Voyager, and $40 in Bitcoin at Celsius. These platforms will be covered in greater depth soon here on CryptoCast, presented by Cream Scheme. What are your thoughts on moving away from bank savings accounts in favor of stablecoins and these interest-bearing crypto accounts? Leave a comment down below. Subscribe to us on YouTube, Spotify, Apple Podcasts, and SoundCloud, and scheme with us on social media, Instagram at cream_scheme, and Facebook, Twitter, and Tumblr at Cream Scheme. Thanks for tuning in to this episode of CryptoCast presented by Cream Scheme. See you on the next one. Peace.